but you know what it's time for right now, Greg? Do you know what it is?
Game time, brother.
We're live on Facebook for the Not Your Average Investor Show, Thursday edition, JWB Rental Income Property of the Week. We are coming to you live from the eye of a tropical storm because in Florida, we eat those things for breakfast. I'm your host, Pablo Gonzalez. With me as always, is a man they call GC because he's a guy who cares and because his name is Gregg Cohen. Welcome, Greg.
Thank you, everybody. Good to be here with you. Good to have all of our friends on Facebook tuning in as well. I feel like we don't give enough love to our friends that are on Facebook here, right? So thank you guys for being here.
You are right. You are right. We don't give enough love to Facebook. It's great to have them on. I got a lot of things going on, right? Like I'm trying to moderate everything and a couple of screens and pay attention to all the golden nuggets. But it is cool that, in our Facebook group, there is people that tune in as well. They just passively consume the show. They're commenting in there. We go back in there and we talk with them throughout the week. But for anybody that's new today, there's a little bit of housekeeping that we go into. First, number one, what you should know is that this is an interactive show, particularly this Thursday show, when we're going to break down a rental income property and the numbers and what it all means and what you need to think about. We want you asking questions because this is the time to really, really dive into the numbers and the model and whatever you want to pick from Greg's brain, right? So there's two ways to do that. One is this fabulous chat box that we have here where we see Margaret Smith. Welcome, Margaret. Welcome back, Marilyn and Lee and Jake and everybody chatting with us. Now, what you'll know is since they've been here before, they realize that when you open up that chat box, there's a blue box right above where you type that says panelists. If you got to drop that down to put panelists and attendees so everybody sees it. If not, it just comes straight to us. I try to keep track of all the chat stuff. We try to play to it, but there's a lot of value in the group knowledge that's in here right now. We have, 15 to 20 regulars that come every single show, and they're super knowledgeable real estate investors that give a bunch of value in here, right? Sergio, good to see you back as well, my friend. And then second of all is if you want Pratap, good to see you back as well. And if you want me to ask a question to Greg himself, or you want something asked live on the show, the best place to do it in the bottom right, there's a Q&A box. If you pop that open, put the question in there, and that's the easiest way for me to keep track of it. Because as you can see in the chat box, it moves quickly because people are interacting in there, while in the Q&A, it just stays there live for me. I can keep track of it. Leo, welcome from California, my friend. Good to have you back as well. And last but not least, if you want to get a real primer on rental property investing, if you want to download the real estate investor package, what is it? I just lost it.
Toolkit.
The toolkit. God, I'm a toolkit.
It's a toolkit. It's so not a package.
Yeah,
it's a toolkit.
Package. Who uses a package? Toolkit, right? Something that is useful for you to use, not just for you to open and put on your coffee table over here. But if you want the package, the toolkit that includes the spreadsheet that we're using today, that we're going to be fiddling with and showing you how to use, then go to jwbwebclass.com. Now, if what you want is a personalized next step, you're ready to maybe invest, or you have a specific question about whether you qualify or where the funds can come and how to build a plan, go to chatwithjwb.com, hop on a call with the Mikes, and they are super, super, super helpful people. I've been through it recently myself, and it's a great experience. Good afternoon, John Henning. Good to have you here as well. And without further ado, Greg, are you ready to get into the property?
Let's go, brother.
All right. We are going to be magically whisked away to 5858 Begonia Road. That sounds like the name a great aunt would have, doesn't it? Begonia.
Great Aunt Begonia.
But my great aunt Begonia. All right, Greg. Do you see it on the screen?
Now I do.
Okay. So what I'm looking at right now, and for those of you that don't know, we repurpose this stuff into podcasts, so it's easy to listen in the ears and while you're driving around. So we're gonna describe some of the stuff that we're seeing visually here for our friend that's listening to us in their ear in the future today. Hello. And Greg, the first thing that I notice here is 5858 Begonia Road, 32209, one of your zip codes that you guys are well steeped in, correct? Purchase price of 144,000, 4-bedroom, 2-bathroom house. It has a driveway, has an estimated rent range of $1,050 to $1,100 a month. And now what people really want to hear about is that it has a estimated conventional financing total monthly cash flow of $243. And it has a conventional financing total ROI of 11.07%. Gregg, as always, I'd like to, for those of us that are joining us for the first time, can you please go over those two numbers, right? Because at the end of the day, this is what you're selling. You're selling this return, you're selling this cash flow. What does this cash flow represent?
So cash flow represents the net amount that you're going to keep in your bank account each month. So you've got the rental income coming in, you've got the expenses that happen every single month, and that 243 some odd dollars right there is the net amount that you're going to keep. And that's that positive cash flow, which is why you're coming to this asset class. It's this positive cash flow that you can get from rental properties. And that's what's reflected there. But let's talk about what's not included in those numbers, right? So that's everything that's a standard sort of every month, right? The house is rented minus your principal, your interest, your taxes, your insurance costs, your property management fees. That's a normal month. Now, what's not included there are things that do not happen every single month. So your maintenance costs are not included there. Your vacancy costs are not included there, as well as some of the positive things that don't happen every single month, right? Or at least you don't see them in your bank account, right? Your principal pay down of your loan is not included there, which is a benefit to you. And your tax savings are not included there, as well as our good friend home price appreciation is not included there. And as we know, Jacksonville is a growth market. All of those profit centers that we just talked about do come to you, but they're not included there. That's that normal month, what you're going to see in your bank account. That's what's reflected there.
Okay, so I'm getting some feedback from the chat that the image is blurry and people can't see it very well. I've tried to unload it and reload it back in a couple of times. I can read it, but it's still not crystal clear. I think it might be the feed, it might be not. We're just kind of roll with it and talk through it. So, all right. So the 243, that's cash flow. That is a check in your bank account on an average month that doesn't include all these other profit centers that you talked about.
Yeah, let me actually just get real specific, because some on the call have never actually experienced this cash flow. And Pablo, you haven't experienced this yet because you haven't closed on the house yet, right? So what actually happens is JWB sends the rent that we collect to you. We keep the property management fees, which are 10% of the rents, and we send that entire amount to you. So what actually, if we're getting really specific, what actually goes into your bank account is the full rent minus the property management fees. And then Pablo, in your case, you're buying your first rental property with us. It's your responsibility to make your payment to the bank, right? And your bank payment on your loan is going to most likely include your principal amount to pay, your interest to pay on your loan, including your property taxes and your insurance costs. So technically speaking, you get a lot more than that in your bank account. And then we know that you have these other expenses, and this 243 is the net amount once you actually make your payment to the bank, if we're getting very specific there.
Look at that. A new thing, that very basic, that we have yet to discuss in almost the full year of the Not Your Average Investor Show. Cool. Okay. So that's interesting to know. So you're getting this bigger check, and then you're on the hook for paying the mortgage and the different expenses that you have. Is there automated systems that people set up for that, or?
Absolutely. And so what we recommend for clients is to make that automatic payment from the bank account that you set up specifically for your rental property portfolio, and have that automatic payment, which takes care of your principal, interest, taxes, and insurance, made every single month to your loan. And so Like clockwork, JWB delivers the cash flow to you on the 25th of the month. And then on the 1st of the month, or whenever you want to set that automatic draft to go to the bank to pay the loan, that goes out and you just continue to operate like that. And that's how normal months go.
Okay, cool, man. That's a really good brand new explanation of cash flow. Definitely going to use that in the micro content going forward here. Then the other number, right? This 11.07% estimated conventional financing on total return on investment. Talk me through that one.
So that includes almost everything when it comes to your return on investment. So those things that I had mentioned that happen, but not happen every single month, or they don't exactly hit your bank account every single month. When I was talking about maintenance cost, vacancy cost, tenant placement fees, those are costs that really happen, but they just don't happen every single month. Well, that 11.07% return on investment, that includes all of those costs. It also includes the other profit centers, almost all of them, right? It includes the profit centers of your tax savings. This means the income tax that you do not have to pay because of the tax savings that you get from rental property investing. And it also includes the principal pay down. And some folks are confused when I mention what this is. You know, if every single mortgage payment that you make to the bank is comprised of principal and interest. And in the beginning of the loan, it's a whole lot more interest than it is principal, but there's still principal to be paid down. It might be $150 out of your payment might be principal. And when you're investing in a cash flow positive investment like this is, and your resident is paying your rent for you, your resident is actually paying down that $150 down of your loan for you. And this is a real benefit. There might be, $1,800 or $2,000 in the first year of your loan that gets paid down. And so if somebody pays down your loan for you, that's a return. That's like money in your pocket in essence that you would have paid down that loan. And so that's that other profit center that we're talking about. So 11.07 takes everything, your gross income minus all of your kind of normal monthly expenses. It includes the expectations that we have for your maintenance costs and your vacancy costs that will happen at some point. It also includes cost of tenant placement fees. That's something to pay attention to if you're comparing to other markets. Not all providers include that tenant placement fee in these expectations, but we do. And then it includes the profit centers of tax savings and principal pay down, leaving out one big profit center that it does not include. Pablo, what would that be?
Let me see. I see here it shows 0 under the appreciation rate. I would assume that home appreciation is a profit center, right?
Home price appreciation is not included there. We do not include it there because we're just ultra conservative, and we want to make sure that we can focus on the things that we can control for you. And a 9 to 11% return is what we shoot for all things not named, including home price appreciation. And the reason at the core of it, I believe if you hold on to your assets, history shows us that you're going to experience significant home price appreciation in a growth market like Jacksonville. But I can't control how long you hold on to your assets. And that's a big if, right? If you listen to the show and you follow what I believe, you're going to hold on to your assets for a full market cycle or longer. That's what I've been doing. So I've started to invest in 2006 and still hold those assets today. And the reason that I do that is because when you invest for a full market cycle, you can count on home price appreciation. However, I can't control what you, the investor, is going to do as far as how long you're holding on to your property. And we also are very conservative. And so in that regard, if you're not planning on holding on for a full market cycle, I would tell you that home price appreciation is speculative and that you shouldn't count on it. And so that's the reason why we don't do it. But when you include home price appreciation, especially for a conventionally financed purchase, the true profit potential of a rental property, and this is the reason why many investors, many folks rush to rental income properties, it's because leverage on an asset that grows over time is so powerful. Your full profit potential is well over 20% for an asset that is appreciating at a rate of 4.3% per year. And I think you're teed up there, probably. There we go, 26.71%. That's a better depiction of the full profit potential if you follow what Pablo and I talk about, which is buying and holding in a market like Jacksonville with a team that can support you for the long run and holding on for a full market cycle. This is why people come to this asset class.
All right. That was a mouthful of information. So to kind of recap there real quick, when you add appreciation rate to it, it supercharges your return. And Jacksonville is, out of all the cash flowing rental income property markets, Jacksonville happens to have the highest home price appreciation historically. And if you are planning to hold for a 10-year to 20-year window, you should be able to count on it.
That's what history teaches us.
Did that work for you during the financial bubble under the last real estate crisis, Gregg?
Well, it did. If you go the full market cycle, if you go beyond just the 4 years of, we'll call it pain that we all endured, where prices from 2007 to 2011 fell 35%, right? There, prices did not go up 4%, right? That's why I'm saying you have to invest for a full market cycle, right? If you look at any 4-year window, I don't know what things are going to appreciate. I have an inkling. I look at the metrics and it's a kind of a guide. But 4 years from today, I can't tell you if you're going to see on average 4% appreciation each year. And that's why we don't reflect it in the property valuations. But what is really cool is if you go for a full market cycle that surrounded the Great Recession, if you go from 2001 to 2020, our average appreciation here in Jacksonville per year is 4%. And so this concept that history repeats itself as far as home price appreciation plays. You can go to 10-year windows, 15-year windows, 20-year windows, and in other markets, not just Jacksonville, right? You can go to these other markets and look at their windows, and their home price appreciation for those windows is generally very close to what their historically accurate home price appreciation rate is. And that's why it's so critical. Most investors don't get this, but that's what puts Jacksonville heads and shoulders above other markets. It's because you have this floor of positive cash flow that you get, but your growth opportunity is so much greater as long as you are committed to buying and holding.
Makes a lot of sense, man. And listen, I'd be remiss not to point out the fact that when I put in 4.3%, it balloons from 11% to 26.7%. Can you talk us through why that just happened? And, that clearly makes the appreciation piece a significant portion of the equation here, right?
Yeah, this is why we're going so strong in helping clients. If financing is the right thing for their goals, and it's not always the right thing, we're going to help you build that plan. But if financing is the right thing for your goals, this 27% is due to financing. It's due to the impact of using leverage. Because when you're in a market that appreciates at 4% a year, but you only put down 25%, right? You only put down 25% instead of putting all of your cash into the investment. Your return on investment from the home price appreciation is actually 16%. It's not 4%. It's actually 16%. And so that's why, especially right now with interest rates being incredibly low, we estimate 4% loans for investment properties here in Florida. I've never seen it that low, and probably will never see it again that low. In future years, we would expect interest rates to go up. That is why this is such a critical moment to build wealth for your financial future. And really, the way I look at it is for generational wealth. More generational wealth is built when you're in an interest rate environment like this and you have access to leverage like most investors do out there through rental properties.
Interesting, man. So, all right. So let's talk about the hook point of the show, right? You made a point to point out the fact that you can get into this investment for just $30,000, a little bit over $30,000. Can you talk me through that, Gregg?
Absolutely. I felt a little bit like a used car salesman when I said, you can get into this if you only have, $200 a month or whatever. But whatever, we'll roll with it.
Listen,
Uh,
hey, on a consumer level, that's interesting to me, right? Like the property that I'm investing in was also a lower price property, and the fact that I could get in at around $30,000 is the reason why I decided to go turnkey rental as opposed to private lending, right? So, you know, I know you felt like a used car salesman, but I think it's a valuable piece of information to give people.
it is, right? I mean, what's one of the biggest areas or biggest obstacles to getting into rental properties? It takes money to get in, right? These are no money down deals. And when I was starting, it was really hard to come up with the capital to invest in my first rental property. I had to get creative about it. I had to take a loan from my dad, and I had to get him on board and investing into my future, and really kind of go down that route because I didn't have that money. Well, it's always great when you have a low priced property because that allows you to get in for significantly less cash out of pocket. In rental property investing, in real estate, most people assume it has these incredibly high barriers to entry, because properties cost $200,000 or more depending on which market you're in. But when you can use effective financing, it's going to limit that. And this is also another reason why this passive investment concept really plays well for those who might not have endless capital. It's because if you're an active real estate investor, you generally do have to come up with the hundreds of thousands of dollars to buy a property and to renovate the property. The same financing is not available to you. So it's one of the things that we love about turnkey rental properties is that, while your purchase prices are going to be between 150-ish to 210-ish thousand dollars, you're out of pocket because you're able to put either 20 or 25% down is significantly lower, and it allows more people, especially younger investors, to start building their portfolio earlier and earlier.
Excellent. So should I be going to this analysis conventional financing tab to show the down payment here? And
Yeah. So
okay.
let's do that. So I wanted to point out that, yeah, we'll go there. So you can see those financing assumptions. Let's go ahead and zoom in there on those financing assumptions. All right. So in all of JWB's standard property evaluations, you're going to see our expectation is 25% as far as what your down payment is. Pablo, why do you think we do that?
Because you like to underpromise and overdeliver?
That's right. Right. If we're trying to limit the amount of out of pocket for somebody to invest, and actually supercharge our returns and make them as high as possible, I could actually put the standard evaluation at 20%. And because many investors choose to put 20% down versus 25%. So I thought we'd go over some of the benefits of doing that. A lot of people do that. And when it comes to this evaluation, the key that I wanted to make you guys aware of is that, in any property evaluation that you're looking at when you're deciding to invest in a rental property, you want to make sure you're comparing apples to apples, because it is so easy for me to put an evaluation here that would make this not an 11.07% return on investment, make it a 13% return on investment. And, I talk to many investors who say, well, I could get a 12% return investment over here in this market versus an 11% here in Jacksonville. Does that mean that the 12% is better? Make sure you're comparing apples to apples, because it is so easy to supercharge returns and turn this 11 into a 13 or a 14, right? You've got to know what assumptions people are using. And down payment assumptions, a big one. Closing costs is another big one. Maintenance costs is another big one. The list goes on and on. So I got a little bit off tangent there.
No,
but
I like it. I like it. I like it. So if we're educating people on how to see if you are comparing apples to apples on a comparison, you want them to look at the down payment tab, right? Like, are you estimating for a 25% down payment versus 20% down payment? You want people to make sure that closing costs are included in the calculation, right? You want people to see that, there's the maintenance rates that you guys are making assumptions for here. Here's a 6% maintenance rate.
Mhm.
vacancy rate of 3%, right? Like you want to make sure that all that stuff is put in, HOAs if there is any, insurance if there is any. Are there any other kind of like gamifications that people need to look for?
Tenant placement fees.
Placement fees.
So other companies will either just not put those in, or they'll put in a really small percentage of them. JWB, we actually put the full tenant placement in. And so in this property, that's an additional $1,075 of cost, which limits your, which reduces your expected return on investment, right?
Is this right here? This is the 1,075.
Yeah, if you want to, you know what, let's do this. Let's go back and kind of get back into that 9 to 11% return. So if you would, Pablo, let's go ahead and get rid of that home price appreciation, just so we can kind of standardize it. And I'll show you just how easy it would be to promote higher returns, and that what a lot of other places do. All right, so now what we're looking at is 11.07% conventionally financed return on investment. If you would go to that conventionally financed tab, we're going to make some changes here, and I'm going to show you how the returns spike. Okay. So go to that tab. There we go, and go down to let's see, row 28. You'll see, tenant placement fee. Go to the right there, column F, 1,075. Just delete that right there for me. And the cool thing is that you guys can play along at home too. If you do download the investor toolkit and go to jwbwebclass.com, this is your gift. You can do this. This is a great way for you to compare apples to apples. Look, I just turned this investment expectation from 11% to 14%. Now, the justification that people may say is, well, that doesn't happen every single month. But that doesn't make any sense to me, because year one, you want that tenant placement fee to happen because you want your tenant to be placed, right? I don't know any other property management companies that don't charge a tenant placement fee when a tenant is placed. So, that is one that I don't really, it's hard for me to even justify why other people do that.
So $1,000 right off the top will increase that, right? Like even on a one-time fee that only shows up once a year, it's still gonna move the needle like that. Where was this? Okay.
Yeah. Yep.
So let's put that back in.
Yep.
1075. And do you want to, while we're there, right? Like, where does the tenant placement fee, what does that figure come from though? Is it $1,075 for anybody, or is that, how's that calculated?
Yeah, I'll walk you through that in a second. But Pablo, you put it in the wrong column there. You put it in the monthly column. Go ahead and put it in year one, column F there. That 1,075.
Column, got it.
There we go. Well, that tenant placement fee is what's charged by your property management company when they place a tenant. It's equal to 1 month's rent.
Okay, so it's 1 month's rent, which is why when I said gross rental income, I had the same number, right? Okay.
Exactly.
Good to know. All right, so that seems like an easy way to juice things. Do we want to look at this thing at 20% then?
Yeah, let's do that. So we're back to 11%. Now let's change to 20%. And let's see what the returns are. Let's do that. And let's take out closing costs, because this is a common thing. I see very few other turnkey operations, including closing costs.
Okay, so we just dropped that. Estimated closing cost, 0. Boom, 14.23%, up from 11%.
There you go. Imagine if you did both of those things, right? This would be, I don't know, what, 17% return now? You see how easy it is for turnkey operations out there to put an evaluation in front of you. And if you're not really paying attention, an 11% return here is really a 17% return by some other name.
That makes sense. All right, so I'm putting back in closing costs. I'm leaving in that 20% down payment now. So now everything is equal. Yeah. Now we've just gone from a 25% down payment to a 20% down payment, and the ROI has gone up by more than 1.5% as well. Can you explain why that is?
Yeah, absolutely. So your return on investment is going to be determined by how much net rental income you get, and the profit centers of your tax savings and your principal pay down, all that net amount divided by how much you put into it. What's your initial investment? And so if you put 20% down instead of 25% down, then your initial investment is going to drop. Now, there are some other things that are going to go up, right? If you're putting 20% down instead of 25% down, Pablo, what do you think that does to your monthly mortgage payment?
It would increase your monthly mortgage payment.
Exactly, right? You've got more of a loan to pay back, so your monthly expenses are actually going up. But what's more, by going up to 12.65% of a return on investment, what that is telling you is that if you weigh the additional cost of the monthly mortgage payment going up every single month and factor that in, but you also factor in putting much less down, overall, it's a better and more efficient use of your capital, because your return on investment is actually 12.65% versus the other way around, when you had a lower payment, but you had more invested, was only an 11.07% return.
So when I hear that, I think if you are in it for the long haul and you are really, really focused on overall ROI, it behooves you to to conventionally finance it and put a lower down payment. If you are focused on a more short term and what you really care about is the monthly cash flow, then maybe it makes sense to pay a higher down payment or pay cash or whatever.
It's not an always a one size fits all answer, because I'm gonna play devil's advocate with you and give you another side of the coin, right? It really comes down to working with somebody to build a plan. I'll tell you, most people do go down the route of putting 20% down when there's an opportunity to use the same amount of capital and purchase more properties, because a better portfolio for you overall to produce consistency is a diversified portfolio. And when I say diversified, I mean multiple assets. So if you have the same pile of money, but you can buy 3 properties instead of buying 2 properties, then that is very common to go 20% down, right? But there is also something else to consider with going 20% down. It's not just that you have more of a loan to pay back. You're going to get a slight decrease in your interest rate by putting 25% down versus putting 20% down. So that's why it's not always a one size fits all answer that 20% is the way to go for individuals. We're really looking at kind of the pile of money. We're looking at the long term, what's important. We're also just working with the client and seeing what their threshold for risk is, right? There are some people that just say, I want to put 25% down. I understand that it's a worse return on my investment, but it helps me sleep better at night. And we say, that's great, right? So if I was being completely accurate in the evaluation, I should bump up the interest rate slightly for the 25% return on investment. But, ultimately we're kind of splitting hairs there. At the end of the day, we're going to be able to produce a 4% interest rate for you, whether that's a 20% down or 25% down. So kind of didn't go through that exercise there, but that's one reason why people would lean towards 25% is you do get a slight decrease in your interest rate.
That makes a lot of sense. Okay, Greg, I'm going to ask you a funny question now. I'm going to put this thing back on here. Does someone live in this house right now?
It's your Aunt Begonia, man.
My Aunt Begonia lives in this house.
Your Aunt Begonia, look at this beautiful property.
Listen, man, I bring it up because I'm used to seeing just better looking houses on here, right? Like, what's the current state of this property for my Aunt Begonia?
So this was a tough one for me and Pablo to prepare for, because of course, most of our inventory sells prior to either the renovation being done or the construction on the home being done. And so when you're getting pictures for that, it makes it kind of tricky, right? Obviously, this house is going to be in great looking shape when the renovation is completed. So we sent a photographer out, which I normally do, and either between Google Maps or between the photographer taking pictures of the actual, construction zone, the pictures look pretty good. Well, not this one on good old Aunt Begonia's house. This was the best picture I could get, which is actually from Google Maps. So this is a picture of, I think, 2 years ago on Google Maps, Street View. Just to show you the frame, the bones of the house, how it looks here. It's on this corner a lot here on Begonia Street in the north side of Jacksonville. That is not how this house currently looks. That is not how this house is going to look for the investor that is purchased or will purchase this home. But that's the best picture that we have to just give you the frame.
So paint me tell me on a house like this, right? Like what is JWB going in and doing to it when they find it in a condition like this? Give me like a typical renovation that you do to something like this.
Yeah, our average renovation is over $40,000. And so you can see Aunt Begonia's house there. I mean, I don't have the square footage right off the top of my head, but probably 1,200 square feet or so.
It is, what do we got? Where's the square footage here? Square footage, 1,463 square foot, bigger than I thought.
There you go. 1,463. We like that, right?
Yeah.
Small home overall, though. To put $40,000 of work into a house, I mean, you're basically rebuilding the house. The major mechanicals, generally all of them are either replaced or they have got to be in tip-top shape. Things like ACs, right? Your roof, flooring. I mean, you go in, we pretty much turn this house upside down. As you can see, Aunt Begonia's house needs to be turned upside down based on that picture.
Makes sense, man. The other thing that I want to ask you about, Greg, is this is clearly a renovation property, right? Like you guys are known for doing new construction and renovated properties, right? You kind of invented the whole build to rent space here in Jacksonville, which landed you on the front page of the Wall Street Journal a couple of times, which I think is pretty cool. So I humble brag about it. We haven't really profiled a new construction property in on the show in, let's say, about a month, right? Like what's going on? Are you deliberately picking out renovated properties? Is new construction? Do you have less inventory? What's going on?
Yeah, for these properties of the week, I try to pick the ones that are most representative of what we have available at the moment. And new construction for us is certainly something that we have done since 2011. We do it now. But we have less new construction properties today than we've had in the past, or than we will have in the future. And so the properties of the week, I always try to reflect kind of where inventory is at the moment.
Okay. So what is driving that lower supply?
So good old COVID.
Makes sense.
Yeah. When COVID broke, right, we did a new business planning session between my business partners and I, and we wanted to understand really where the business was, where were there liabilities, right? Where did we have concerns? Where did we need to pull back? All of these things. And 99% of the business, we went full steam ahead. And all of our staff was taken care of. We got right on a call with everybody on our team and said, you have nothing to worry about for your jobs, right? And this was before any of the stimulus was known and all this other good stuff, right? We continued to buy through COVID. So we were purchasing properties when every other investor said, whoa, I'm not going to do that. Why do you think we did that, Pablo?
Because you, from the beginning, called the fact that property values weren't going to go down because you had good data.
And I have a good marketing partner to make sure that message has spread like wildfire. Because, when you get it right, it's nice that you can kind of time stamp that and date stamp that, right?
It's nice.
It wasn't just us getting on, on the show and just talking about it. Everything I share with you guys is what I actually believe and where I put my own money. So we continued to buy. Well, we looked at it and we said, okay, let's make sure that we're making the best risk-adjusted decisions here. And we looked at construction and we said, we've got a ton of new construction properties that are finishing. We have a ton of new construction properties that are continuing to be built. We decreased the number of releases of new construction slightly. It might have been 30 releases each month prior to, when COVID broke. And I think we dropped it to 20. And so now what we've seen is that the result of that 6 months later or whatnot is, our new construction inventory temporarily right now is a little bit lighter than what it normally is. We still do have new construction properties. But normally it's 75% of our inventory, right? It's not 75% right now. It's less than that. And there have been some other challenges when it comes to new construction, right? The building department has been completely overloaded because what has happened is once COVID was sort of known more to the home building industry and the renovations that were done and all of that, Well, building, acquisition, all types of construction ramped up considerably. And there's a lot of supply chain issues with construction right now that are slowing the construction down, as well as building departments that can't keep up with the number of permits. So, it was a strategic slowdown for us. And then, we're all kind of dealing with this COVID world where there's supply chain issues and whatnot. So we're a little bit lighter on new construction, which is interesting because, pricing for the renovated homes that we've been able to sell lately been a lot lower than what we normally have. I mean, I have talked a lot. Do you remember what our price points are normally, right? 150 to 210.
Yeah, correct. And we've been bringing a bunch of lower priced opportunities to the table, which is one of the ones that I jumped on, right? So
that's where I was going. Going, right?
Yeah.
So it plays, the message plays really well with the topic of like today's teaching moment, which is, Begonia is a $144,000 asset. And if you combine putting 20% down, right, you've got an opportunity to get into a rental property investment here for much less than what I would say is normally available, especially in a market like this where prices continue to go up. It's going to get harder and harder to get into an asset for, call it $30,000 or somewhere around there.
That makes a lot of sense, man. Two things that I would like to say is, one, it's a lower price point, but the ROIs are still elevated because normally they're constant. And on top of that, it's the interest rate play that's happening right now, right?
Yeah, absolutely. And, people ask about the difference between new construction and renovations. We love both. Pablo, you decided on a renovated home, right? You know more about this from kind of under the hood of JWB from a client perspective than anybody else, right? Most people say, oh, well, new construction is, it makes sense because you have lower maintenance and all that good stuff. It's really not hard to show people like, wow, it's a brand new asset. Your resident's going to love it. But you made the decision to invest in a renovated home, right? Why did you
Correct.
make the decision to do that?
Lower price point.
Yeah.
Right.
Did you feel like, talk about like the long-term return on investment as well? Like from a maintenance perspective, what didn't give you concern that somehow you're investing in an asset that's going to have tremendous amount more of repairs and ultimately might not be a win for the long run?
Sure. You know what? Maybe we can actually pop in the property eval and we can talk about it, right? But I've grown to understand from doing all these different property valuations with you and being a part of the show that number that you put up at the end, that ROI that you are showing, is already incorporating maintenance, right? So as we have gone through all the new construction homes and the renovated homes, I have consistently seen that ROI stays consistent and the maintenance number on the bottom, which I'm going to share right now, goes up or down, right? So at the end of the day, all I'm buying is this right here, right? Like this cash flow and this percentage of ROI, right? While like this maintenance number that on this property, which is clearly going to be heavily renovated, is at 6%, because I'm assuming that you're going to renovate it so much that the maintenance is not going to be super high. I've seen other ones in here that have like an 8 or 9%. And then I've seen other ones that have like a 3 or 4%, right? Based on what it is. But I know that it's all calculated on the front end to come out to this. And this is really what I care about, right? Does that answer your question?
That's brilliant, right? I mean, you've got to separate yourself and the emotion from this investment, right? And some people have a hard time doing that. At the end of the day, this is an income stream for you. This is a return on investment. This is not where you're living. It's not where you should be expecting to rent to yourself, right? You've got to separate that. So Pablo, what you're talking about is I'm looking at the numbers of this thing, right? I'm never going to go to this house, right? I'm not the same person that I'm renting to, which is great. I'm creating a great situation for somebody. And my return on investment here is over 11%. I don't care when the house was built, because the house is in essence being rebuilt right now. It's being renovated to the standard that we need. And so, the other thing to keep in mind is you're going to hear me talk a lot about how I love new construction as well. You're going to hear me talk a lot about renovations, because I love them both. I have them both in my portfolio. But one of the things I point out to people that choose new construction is that if you're a buy and hold investor, you're not always going to call this new construction, right? You're investing for a 10 to 20 year period or longer if you're like me, right? They don't call it new construction except if it's the first year that it was built. And new construction homes and renovated homes have both been shown to appreciate at that rate that we are talking about, that 4.3% rate. So, the thrill of new construction is not why I love new construction. In my mind, they're all going to be, non-new construction homes for as long as I'm holding on to them. It comes down to what's the best return on investment for me. And no matter if it's new construction or renovation, you can get to that 9 to 11% return on investment. That's what we did for your property, Pablo.
You did. And then I also add in the common sense element of, because JWB does this 600 times a year or whatever it is, I know that the construction team, and being the 800-pound gorilla of who builds the most in Jacksonville, and the people that you use for your renovations versus your new construction are all like skilled and dedicated to you, right? Like I have grown to understand that I can really trust your data because it's based on real data and it's not based on just some magazine that is telling you what maintenance rates are right now on rental income properties.
Bingo.
Yeah. And listen, the last thing that I said two things, right? When you said Begonia has 144 and then said 1,000, I thought you were going to say that my Aunt Begonia had 144 years old. And that's where I thought you were going. But listen, Greg, this has been great, man. We've had almost 40 people on this entire time. Really, really good information. I like that we broke into the mechanics on how to inflate an estimate. We hadn't really done that very much before. I like what was the other thing that how you broke down the cash flow for the first time. I think a couple of really valuable nuggets came out of today's shows where I learned something. Sergio has a real quick question. He asks, are all homes, new construction and renos inspected prior to closing?
Absolutely.
Easy answer. So I like that we got into some really, really new material on what seems to be what we do every week, but like it keeps on giving, right? Like this show is great. To go deeper into this idea of what the construction market and your plans for next year, I want to tease next week's episode, right? On Tuesday, we are doing the JWB quarterly market update. This is based on the numbers that JWB shares with their investors and the outlook on the market and what's happening in Jacksonville. We're going to talk about pricing, months of inventory, existing market conditions to what the opportunity is out there. And we're also going to talk about the Jacksonville economy, what you need to know, why we feel so comfortable talking about this historical home price appreciation and the idea that this is a really vibrant, blossoming economy that's good to be in for a long-term cycle. I'm really, really pumped about that one. Apart from that, if you want to download this kit, what we've just been messing around with, right? Like I feel like today was one of the most instructional classes on dealing with the investor toolkit. So I recommend anybody goes to jwbwebclass.com to watch the webinar, download the toolkit. And if you want to, talk to the team about what the next step is, go to chatwithjwb.com and you can talk to the mics about whether you want new construction or renovation in your portfolio, what's available, build you a really good plan. And outside of that, Greg, this was fun, man.
Yeah, it's great as always. Also wanted to just give everybody an update here. Some folks have reached out about the tropical storm that we have here in Jacksonville. And for those who weren't on the call prior to going on Facebook, right, Pablo and I were out running at 5 a.m. I can tell you I'm here in the office right now and it's not raining. The trees are not bristling. Everything is good here. And so, we're always happy to give you the real inside scoop. Come to us if you have any questions about the weather here in Jacksonville. It's not always what the media portrays, but that's a great thing for us, for our residents. And so very blessed.
That's true. That's a great point, man. I forgot. We really are broadcasting in what is the middle of a tropical storm, and it really just feels like a regular summer afternoon. in Florida. Real quick, Luis Visco asks, is the appraisal expected to come in at 144K?
Luis, great question. Yes, the appraisal will come in at $144,000. Our sales price must match the contract price. We do not force you to buy properties that do not appraise, as many other turnkey outfits do. So appreciate the question, and absolutely yes.
And with that, we're going to leave you. We appreciate having all of you on with us. We never take for granted the fact that we get 40 people in the middle of a Thursday, on the middle of a busy work day, to spend an hour with us. It really is validating. It really feeds our soul to be able to provide this kind of value. I'm going to let you in on a little secret that Gregg has to go do a TV interview and then a podcast, which I think is pretty cool. And I know you wouldn't have brought it up. So Gregg, I will leave it to you, future TV star, to say goodbye to everybody else.
Jeez, man, between all of your humble brags, man, it's going to be hard for my head to fit through the door here when I leave here. Thank you, Pablo. And thank you all for being here with us. It's been an incredible week again. Got the Masters to look forward to this weekend, so I'm super excited. And my Steelers, undefeated Pittsburgh Steelers, taking on the Cincinnati Bengals. So a lot to look forward to this weekend.
How close are we to this becoming obnoxious Steeler talk nonstop? Like, you haven't brought it up at all, the fact that the Steelers are undefeated.
Oh, I know. I feel like I've been letting people down, right? I think we need to bring that back. I mean, when we can start talking about the difference between, our market and Cleveland again, that's always a good segue into talking a little trash on Cleveland, a little Steelers talk, which I think it's appropriate. We're going to, maybe the next show, we'll just do all Steelers, and we'll just see how many people we get to show up.
Okay. Deal. Gregg, have a good one, buddy. This was awesome.
See you guys.
Take care.
Bye.